right, good morning, May 10th, 2023, and I'm back with another edition of the Wednesday live show. And this morning, as you probably know, the CPI number came out at a mere 4.9% year over year official annual inflation. And the market reaction's been kind of wild so far this morning. We're 30 minutes into the session here, so at 8:30 when the number came out, the market took a huge leap higher, and the futures did, I should say. The futures spiked initially and then continued up, and so geez, it looks like about, roughly 50 point S&P move higher, and then faded a little bit, and then once the opening bell rang, we got a down move that retraced a lot of it, and as I speak now, it's rallying back up. So basically, there's a lot of positioning going on you know, based on the expectations of how this particular CPI release will, whether it's good or bad, or will affect interest rates, I suppose. So everything just kind of repriced, and so when you get these huge directional moves in the market, a lot of times there's a lot of up and down price action, and then so it's going to be really interesting to see where it settles today, quite honestly, because that's the important thing. So it looks, it's just some pretty crazy erratic action, but quite honestly, it doesn't look on the daily chart, it doesn't look all that dramatic. But on a 5-minute intraday chart, it's pretty dramatic. Market's still kind of trapped in this range it's in. But real quick, take a look at the actual CPI chart here. So there you go. You can see here that the 4.9% number that just came out this morning is slightly lower than last month. It's down significantly from the highs up here, which was 9.1%. The funny thing, I remember this. So this whole curve up here, for most of the end of 2021 and 2022, every time they'd release the CPI number, every time the CPI number would come out, everybody insisted that it's probably peaked. Inflation's probably peaked. And for 6 or 8 months here, you would always hear that, okay, this is probably the peak inflation, and then finally it did peak, right, at 9.1%, which is insane. That's crazy rate of inflation. But keep in mind that what this number represents is the rate of inflation, right? So in theory, if this is accurate, and the expectation was 5%, it came in at 4.9%, which is, and then of course everybody picks apart the CPI, which, I can remember just, since, well, geez, over the last, maybe 10 years or something, or 15. I don't know exactly the time frame, but I can remember, reading about all the different ways that they were going to adjust the way that they calculated CPI, right? And so somewhere along the way, I don't remember if it was 2021 or 2022, but they made another adjustment to the way that CPI was calculated. And so you've all seen it. If you use the way it was calculated back in the 80s or something, it'd be much higher and this and that. So, in theory, the inflation rate on a lot of stuff, especially the important stuff, right? It's always the stuff that's really important where the price increases, and so, theoretically, the average price of stuff has gone up, 4.9% year over year, but that doesn't mean that when you go to the store to buy something this week, that doesn't mean that the price might not be up 10%. That's kind of how it works. So everybody knows that, the cost of living and the official CPI are two completely different things. And of course, a lot of it has to do with the price of gas at the pumps. So I quite honestly, I'm not, I don't bother to pick apart the CPI numbers and, figure out how much of it's housing. And I mean, all that data is available. I look at it sometimes, but I don't bother myself with the minute details. It's interesting to read at the time, but the price of gasoline at the pumps is, and of course, you always hear excluding food and energy price, volatile food and energy prices, which is true because, um, just silly little stuff like a few months back, I was at the grocery store and strawberries were like $2 for $5, and so I bought one, right? And then I went back like a week or two later, and it was 3 for $5, and I was like, wow, this is great, and so I bought one, and then I was at the grocery store yesterday, and it's 1 for $1 for $5, and so those are dramatic swings in price, and so you see that all the time. And anyway, long story short, 5% inflation is still, just round off the 5% CPI, is still well over the Fed's 2% target. So the Fed raised a quarter point last week when I was here. We were talking about it was, Fed announcement day, and so they raised a quarter point, and I suppose that they put the idea of a pause on the table, but they didn't come out and say they were going to pause. And so now everything's kind of hinging. Now that this CPI number's out, the market's going to sort of find an equilibrium level by the end of the day or the end of the week. The end of the week close, I suppose, will be, probably the most important thing. But getting back to my original point, the whether the Fed has another quarter point left or whether they're going to pause in June is the next big question. And then I saw this morning that, based on today's CPI number, the market's pricing in, for whatever reason, the market is pricing in like for them to start cutting rates, which is crazy because just yesterday, Fed Speaker John Williams said that they're going to hold rates, at the peak levels throughout the whole year. And they've said that over and over and over for like the past 2 years, as they've been fighting inflation, they keep saying, every Fed speaker says that there's no plans to cut rates and they're going to hold rates at these peak levels through the end of this year. And so, here's the thing is how even at this clip right here, you're probably, I mean, just even at this clip, if everything stays the same, you're probably talking the end of the year before this chart would come down to 2%, if it even does, right? And then, of course, there's the whole idea, there's the concept here that if the inflation rate, comes down, it could be because the economy is slowing down significantly, right? So, I mean, like I always say, there's lots of moving parts to the puzzle, and it's hard to figure out. But anyway, long story short, the good news is that the inflation rate's not like sticking up here, but the bad news is that, everything that the prices that all went up and went up and went up when inflation ramped up, those prices aren't really coming down. Like nobody's lowering prices unless demand slows down dramatically, in which case, then you could be headed for a recession. And of course there's a debate right now whether we're in a recession or whether we're going to have a recession or a soft landing or a hard landing and all that. So, economics is what they call a dismal science. So, but hey, and Powell has come out in the past and said that 5% inflation is not acceptable, right? So it's weird to me that they keep reiterating and saying that they are not planning on cutting rates, and so the only reason they would cut rates would be as if there was some sort of a crisis, and apparently, the so-called banking crisis that we've experienced recently didn't cause them to pause. Right, last week, I mean, they didn't pause because some of the banks were going under, and so, um, whether they'll pause in June remains to be seen. But I honestly, it's hard for me to imagine that they're going to just start cutting rates with inflation at 5%. I mean, the thing of it is, they're concerned that what's going to happen to this chart here is that inflation is going to come down, still remain well above their target, and then start to increase again. So that's what they need to. I think they're determined, or they pretend, they say they pretend they're determined to get it back down to 2%, and they're still a long way from that. So anyway, let's take a look at the market reaction here. So interestingly enough, the market is just kind of hanging at the same level that it's been stuck at for all this time. And we had a couple of really, really super dull days. So this day here, Monday, right? Monday was the low for when we pull up SPY here. So SPY actually gives a better sort of indication of the actual, cash session of the market. So the SPX, I'm not sure how they calculate the opening price, but SPY actually sort of reflects better. I've been saying this for years, what the opening price was. And so if I want to see what, especially in the morning, if I want to see what the opening price looks like, I always pull up SPY. So interestingly enough, you see how we had a pretty significant gap up this morning, and then it came down and closed the gap. Now it's kind of rallying back up. So, but pretty muted day so far. It's going to be interesting to see if we break out of the upper or the lower end of this intraday range here, because this is not really a long range day by any means, although theoretically, like, the futures have had a pretty big move. Like I said, it was about 50 points from this morning to the initial pop here. But anyway, what I was saying a minute ago is that Monday was the lowest volume day in the S&P since last Thanksgiving. Isn't that crazy? So, and I don't have the volume on this chart here, but let's go back. So let's see. Last Thanksgiving was that half a day, half a trading day, probably right there, like this day here. And so Monday was the lowest volume day since last Thanksgiving's half a day of trading, which means that, what that means, I guess, is that everybody was waiting for the CPI number to come out. So there you go. I'll just put that on the chart. So, that just seems kind of crazy, right? And it was, a pretty narrow range, dull day. And yesterday might have even been worse. I don't know about the volume yesterday, but the range on the day and just the sideways price action, it was like watching the grass grow. Yesterday there was very little participation in the markets because the participants, were waiting for today's CPI number to come out. But so the funny thing is that I think a lot of participants expected that today was going to be, one of those days where it was going to blast off and break out of this range and or, sell all the way down. Notice these two little, let me go back to the SPX because I'm going to zoom out a little bit. Notice these two little sell-off days here. Like market had a couple little dips there. It's kind of an odd looking pattern, to be honest with you, but notice how they were just right above that 50-day moving average. And so you remember last week we were here, I was talking about the 50-day being, significant support. Here's your 200-day just below it, another level of significant support. And so, so far so good, I suppose. As you know, as we've been talking about here on the show for a long time, each one of these 100-point little zones here is fairly significant. And so, we dipped about halfway into the 4,000 to 4,100 zone, held the 50-day, and now we've come right back up to where we were. But the crazy thing about this is that here, let me just draw my little it seems like each week I come on here and I draw these little boxes, but look at where we are today and then just take it back to, let's start right there. Why is that so thick? There we go. That's a little bit better. Yeah, I mean, you take it all the way back to in time, and we're talking like a year ago, right? What, today's May 10th, and so let's see, where were we a year ago? 9th, whoop, 11th. Oh, well, a year ago we were actually below this, but just prior to that, 5.6. An exact year ago we had broken down through that. But I mean, the point here is look at today's range, and then look at the time that the market's been sort of stuck in that range. So I think what becomes important here is I'm gonna go with this high from February here, and then I'm going to go with yeah. I mean, I can go with just these recent lows right here. And so there you go. Interestingly enough, if you call that sort of like, if you say that's the equilibrium range now, which it kind of is. I mean, if you think about it, all of April is contained inside this little rectangle that I drew. And so far, all of May is contained in there, right? And it's only the 10th, but you're talking almost a month and a half. And you go back, look at that consolidate. I remember that. That was a really bizarre sort of period of time. Back in June of last year, that was kind of a weird consolidation because the market typically doesn't spend that much time. Typically. I mean, you see here's another consolidation that's similar inside the same range. So it's kind of an equilibrium level, but interestingly enough, the market has spent way more time below this range than it has spent above it. That's basically the only breakout of it, and so it's hard to say which way it goes, honestly. And you guys know that and I've mentioned this a couple of times. When I look at the weekly chart, and I suppose it's because of the, it's obviously because of this. The thing of it is that when you look at a chart, obviously the past data affects, it kind of subliminally affects your opinion. Anyway, my point here is, it kind of looks like it wants to break out and form a big giant cup. And so I mentioned this last week. If this was like a stock or whatever, I'd kind of be leaning towards the idea that eventually it's going to break out, to the upside and form a big. Of course, this is a weekly chart. Nothing happens quickly here, and that doesn't mean that there's not another trip back down to. This is crazy. So this is a 200 week moving average, right? So this is my 200 period moving average. When I switch to a weekly chart, it's pretty uncanny how. Whoops, this is what I was going to point out. Back here, we had that big sell-off in 2018, right down to the 200 week. There's the pandemic sell-off. You kind of broke below it, back above it, but it's kind of uncanny how this 200-week moving average also kind of looks like, a huge support level, and it's sloping up. That doesn't mean that, the market itself over a period of time can't sort of roll back over and take another trip down to the lower end of the range, right? Um, but this particular sort of pattern here, especially the fact that it's got kind of like a little flat top. It's like a big gigantic sort of basing pattern. But hey, I guess if we go into a recession, then you come back down here and test this or the lower end or even break down. I mean, but it's a pretty constructive looking pattern for higher prices. So, uh, you know, when I look at the chart and think about it objectively, it looks like it wants to break out eventually and go higher. And it could take a trip down and come back up. But at the same time, when I think about it, like logically, all the stuff out there, all the problems and issues and just the macro picture. Yeah, that's what I wanted. It's kind of what I was getting at. When I think about the macro picture, you got the debt ceiling thing coming up, which I can remember prior debt ceiling showdowns, and maybe this time it's different, but they always make a huge big deal about it, and then they go ahead and it doesn't become a crisis, right? So it's just another one of those things, one of the games that they play, and so they always raise the debt ceiling. They always have. Anyway, let's take a quick look around. Here's something of concern, right? Let's look at a weekly chart of the Russell 2000, because as we all know, the S&P 500, I mean the market itself, the S&P and the Nasdaq are basically, five stocks, maybe eight. Eight mega cap stocks is going to have is most of the index. And so all the rest of them don't really have that much of an effect. But this is probably, this if you look through hundreds and hundreds of charts of individual companies, what you see is a market that looks a little bit more like this, right? And so, I mean, look at this. There's the pandemic sell-off and the big rally, and then the Russell 2000, we're talking 2,000 smaller cap stocks, spent a year going from 2021 to 2022, basically spent a year going sideways in this big zone, tried to break out. Talk about a false breakout, man. Wow. That's incredible. And so, that's something to, when you're reading your technical analysis textbooks or whatever, or looking at things and this and that. I mean, this is an example for the ages, to be honest with you. This is probably the most textbook example of, and I mean, this is a weekly chart, right? You had that flat top breakout there, and this would have been the area where, especially after, months and months and months of trading sideways, you finally get a breakout like that. And according to most of the technical analysis books I've ever read, that was supposed to signal a big, a big rally higher, and you could measure, the distance it was supposed to rally based on, this move here. But anyway, let that be a good example of a fake out breakout and the fact that anything can happen. But most concerning here is the idea that the Russell 2000 is like right down here, near the pandemic lows, or I'm sorry, pandemic low, not they're near the pandemic highs, right? So there was like the pandemic highs, and so this is still bear market territory. This is bear market stuff right here. So Yeah, I don't. It's hard to know what to make of it because S&P, the Dow especially, and the Nasdaq looking pretty good. This looks horrible. So, but it makes sense. I mean, it's one of those things. So, institutions, hedge funds, obviously, this and that, gravitate towards the big mega cap companies. But it's a little bit concerning here when the breadth is narrow, when the breadth sucks, and when you got the 2000 small caps, basically in bear market territory here, and looking like it could get worse. See, that's the whole thing about this. Not that the 50 and the 200 mean a whole lot to me on the weekly chart, although I just pointed out that it's kind of relevant. But look, you're about to get a death. It's below both of them. It's kind of pinned below both of them. And you're about to get a death cross. So, um, like I said, a lot of moving parts, a lot of cross currents. Take a look at the Qs real quick. Um, Qs have an interesting pattern here, the Nasdaq 100, because same sort of thing that I drew before. It's kind of breaking out of that little sort of flat top pattern there, and the S&P is nowhere near like that high from what was it last summer. Yeah, I zoom in here. Yeah, so it was in August that the market had that pretty big rally, and so this looks pretty darn constructive. But then again, this is Microsoft and Google and Apple, and those companies are, five. You take 5 to 8 companies, and basically how those mega cap stocks move is what this chart's going to look like. So, yeah, it's a weird sort of environment, but it is what it is. I'm kind of hoping back to the S&P, because this is what I call the market. So I'm kind of hoping that one of two things happens. Either this thing starts to sell down and we get a nice shakedown to to maybe these lower levels here, 38, a couple hundred points down, or if the thing can muster a rally and sort of break out of this thing to the upside. And like I said, because here's the thing: is the market is way, way, way too dull for this early in the year. I mean, typically July and August are what they call the dog days. The other thing is the whole sell in May thing is ridiculous because as long as I can remember, at the end of April, they always talk about sell in May and go away just because it rhymes. And if you actually look at the data, I saw a bunch of people post stuff about the data this year. It's like completely irrelevant, right? And I suppose, I mean the basically it's irrelevant, but it rhymes, and so over the years they've liked to make a big deal about it. And of course times have changed too. Back in the old days, people didn't have smartphones and they weren't connected to everything, and so maybe there was some validity to sell in May. And of course, the idea, what I was just getting at, is that a lot of people go on vacation. June, July, and August, not necessarily June, but I guess you could throw June in there. But typically July and August are the dog days of summer. People are on vacation. They're doing other things, traveling. The participation goes down fairly significantly, or it has over the years, right? And every now and then you get, a really exciting July or August, but the volume tends to dry up, and there's lots of days where the market just does nothing, is moving sideways and really super boring, right? And we've all experienced that over the years. So I'm not saying it's going to be like that this year, but my point is that, just the other day, having the lowest volume, and these little tight sort of range. Now that we did get quite a bit of action, like the action picked up a couple of weeks ago. We had this little, there was a lot of narrow range days here, but we had some nice long range days with action, and then leading up to today, it was just nothing. This was like this was like mid-August type of trading and volume, and the fact that the SPY volume, which I guess is probably probably relevant, is just a little bit concerning, right? And the fact that today, I mean, today's a narrower range day than all of this, so it's kind of interesting. Anyway, there's nothing worse than like a boring sideways market. I guess that's my point. You want to see some trending action, trend down, trend up, this and that, but to be stuck in to basically be stuck in a range like this for, this long is a little bit concerning. So, although, in theory, you can say that the longer that the market consolidates in a range, then the bigger the move will be when it breaks out of the range. But so anyway, here's another thing to consider, and I'm going to wrap this up, is if it starts to break out of this range over 4,200, right? And look at that. Look at how it goes back to last fall. Look at that gap down. There was that gap down, and then that's pretty interesting. I may have to look this up. Like, what was the news on 822 last year? What was the news on 822 last year that caused that little gap down and that sell down? And then literally since then, I mean, the market's in like basically the exact same spot it was that day, and has never been higher than that close on 820 or 819. So that weekend, something happened that caused the market to drop on Monday morning, and we haven't revisited that 819 level right there since then. So that's kind of interesting. Very interesting. So anyway, we'll just have to see what happens. I mean, I don't have a huge. The good news is, well, I suppose you call this good news. So we had a couple of recent. We haven't had a lot of activity this year yet. Um, and part of it is that the market has kind of been a little bit dull. Now, there's been a couple of decent setup swings here and that, but with earnings season's just sort of wrapping up, and so now that gives us a better shot. But what I was about to say is that so we've had a couple of recent trades that seemed like they took a long time to play out, and both of them got closed ahead of earnings, right? But they both did really well. So a couple really good swing trades that are closed, and as of last night, there's no open trades, there's no pending trades, couple of real nice winners in the bag, and so now the world's our oyster. And so hopefully we'll start to see some, now that earnings season's wrapping up. See, the problem is if a company's getting ready to come out with earnings, typically, I say not every time, but typically, um, it's just not, it's not set up, because if earnings are coming out, as you know, it's just a crapshoot. So anyway, we'll see what happens there. But for now, keep your eye on this range. If the market can work its way past 4,200, well, then it has a chance of, putting something together. And then, of course, major support below. And so a lot of sideways action. I would like to see things just sort of pick up. And so, hey, who knows? What the market needs is a catalyst. And for whatever reason, today's CPI wasn't too much of a catalyst, apparently. So we'll just have to see what happens. With that said, thanks for tuning in. I will see you same time, same place next week.